Inflation is broadening because the Canadian economy is in excess demand. There aren't enough goods and services to meet the demand we're seeing as people enjoy a fully reopened economy. Employers can't find enough workers, and they're increasing wages to attract and retain staff. With households spending robustly, businesses are passing on higher input and labor costs by raising prices. Higher interest rates will help slow demand and allow supply time to catch up. Consumer spending will moderate as the pent-up demand from the pandemic restrictions eases and the cost of borrowing increases. Housing market activity is already cooling rapidly from unsustainably high levels during the pandemic. And slower global growth will reduce demand for our exports. Taking all this into account, we are forecasting annual growth in economic activity will be around 3.5% this year, 1.75% next year, and 2.5% in 2024. As global bottlenecks gradually resolve and tighter monetary policy works its way through the economy, inflation will start to come down. While we may see a few more months with CPI inflation close to 8%, we expect it to decline later this year, ease to about 3% by the end of next year, and return to the 2% target in 2024. This is the soft landing we are projecting. Interest rate increases can cool demand and inflation without choking off growth or causing a surge in unemployment. Some sectors will be more affected by interest rate increases than others, but the very tight labor market means there is room to reduce the number of job vacancies without having a big impact on overall employment. And with the prices of many of the commodities we export expected to remain elevated, the global forces slowing growth will not affect Canada as much as in many other countries. But the path to this soft landing has narrowed because elevated inflation is proving more persistent. And this requires stronger action now so consumers and businesses can be confident that inflation will return to the 2% target. Our decision today takes the policy interest rate to 2.5%. That puts it in the middle of the long-run neutral range that neither stimulates nor restricts growth. We estimate that range to be between 2% and 3%. We continue to expect interest rates will need to rise further to cool demand and achieve the inflation target. How high our policy rate needs to go will depend on how the economy and inflation evolves. By front-loading interest rate increases now, we're trying to avoid the need for even higher interest rates down the road. Front-loading tightening cycles tend to be followed by softer landings. This argues for getting our policy rate quickly to the top end or slightly above the neutral range. Before I turn to your questions, let me say a few words about the Governing Council's discussions. On a parlé des événements majeurs dans le monde qui font monter l'inflation et nuisent à la croissance. Pensons à la guerre en Ukraine et aux restrictions sévères en Chine liées à la pandémie. On a aussi noté que la résolution des problèmes mondiaux d'approvisionnement reste difficile à prédire. On a discuté du dynamisme de la demande intérieure qui devient un moteur plus important de l'inflation au Canada. Plusieurs indicateurs du marché du travail font penser que l'économie surchauffe, comme le taux de chômage qui n'a jamais été aussi bas, les pénuries de main-d'œuvre généralisées et la croissance plus élevée des salaires. We also reviewed measures of inflation expectations at some length. The prevailing view in consumer and business surveys is that the Bank of Canada will ultimately control inflation. At the same time, these surveys clearly suggest that inflation expectations have moved up and are becoming more dispersed, with more respondents now seeing high inflation persisting. Market-based measures of inflation expectations over the next 2 years, as well as the projections of professional forecasters, have also risen, though they remain consistent with the 2% inflation target over the longer term. While the Governing Council was reassured that the inflation target remains credible overall, we recognized this credibility is being tested. Demand in the economy is running ahead of supply, inflation is high, and uncertainty about the future of inflation, the future path for inflation, has increased. All of that led us to the decision we took today to accelerate the path to higher interest rates. We did not take this decision lightly. We are acutely aware that higher interest rates will affect Canadians who are already feeling the pain of high inflation. It can seem counterintuitive to add to the interest costs Canadians face in order to combat the cost of inflation. But by increasing the cost of borrowing, we will moderate spending and return inflation to its target. We need to get price changes back to normal. This matters because it gives people predictability to plan their spending and saving decisions, to budget, and to live their lives without having to worry about what prices are going to be next week, next month, or next year. The best way to protect people from high inflation is to eliminate it. That's our job, and we're determined to do it. The Governing Council is resolute in its commitment to price stability. And with that, Carolyn and I would be pleased to answer your questions.
Thank you, Governor Macklem. Before we get going, just once again, for reporters who may have joined the phone call in the last few minutes, if you wish to ask a question, please send a brief email to communications@bankofcanada.ca, communications with an S at bankofcanada.ca will get you into the queue. We will start the period of questions now, beginning here in the room in Ottawa, and my first questioner is Paul Vieira of the Wall Street Journal. Go ahead, please, Paul.
Governor, I realize that you've touched on this before, but I believe it's worth asking again, given the magnitude of the rate increase. By lifting interest rates so aggressively, aren't you worried about turning a housing slowdown into a rout and thereby triggering unpredictable effects on the wider economy?
I'm going to ask the Senior Deputy Governor to say a few words about housing, but let me begin by talking a bit about this soft landing. Our objective, as I stressed, is to get inflation back to target with a soft landing. And the path of this soft landing has narrowed. We do have a material reduction in growth. We're forecasting growth this year at 3.5%. Moving down to 1.75% next year. That is a material reduction in growth. That does imply some pain. But we do think there are good reasons why a soft landing is achievable. For one thing, what we're looking for here is the economy is in excess demand. Our objective is to take out the excess and not choke off demand. We need to cool the economy. If you look at the labor market vacancies, unfilled jobs are at a record level. There is lots of room to reduce those vacancies without significantly increasing the unemployment rate. The other thing to keep in mind is that, unlike many of our trading partners, high commodity prices are, while they're certainly affecting consumers in the form of higher prices, they are bringing more income into this country. So we're not being as affected as many other countries by some of these global forces. So we do think our forecast is for a soft landing. As I said, the path to that soft landing is narrowed, and that is an important reason why we took stronger action today to front load the policy interest rates, keep inflation expectations well anchored. That's the best way to get to this soft landing. And I'm going to ask Senior Deputy Governor to say a few more words specifically about the housing market.
Thanks, Governor. So I think it's important to step back a bit on housing and look separately at the effects of rising interest rates on individual home buyers and on the housing economy or the housing market itself and its effect on the broader economy. So at the individual level, we know that there's a segment of home buyers, particularly those that got into the housing market more recently, and they might have stretched to do so, and they may be sitting in a variable rate mortgage. And for those people, when interest rates go up, there's an immediate effect on their payment, and there's no doubt they're being squeezed. But that is a small segment of the population, not to minimize the effect on that segment of the population, but just to put it in the context of the overall economy. A reminder on some important numbers we've given you before. 65% of Canadians are homeowners, 35% have a mortgage. The vast portion of those are fixed rate mortgages, so their payments don't reset when interest rates move. About 10% of mortgages are variable, and of those, most have a fixed payment. So the effects of interest rates on most mortgage holders is not immediate. Of course, each year a portion of mortgages will renew, and so those payments will reset, and they will reset at a higher level with interest rates going up. Also worth adding here that we know that regulations require lenders to test mortgage holders for higher interest rates, so there is a buffer in there meant for exactly the situation when interest rates raise. At the broader economy level, housing is a segment of the economy we know is very interest rate sensitive. Most people who buy a house borrow money to do so, so housing activity is very sensitive to changes in interest rates. When housing activity and prices are high, it feeds through to the broader economy. People are more likely to renovate. They buy things that go along with housing. They buy appliances, they buy furniture. And we also know that housing has an effect on Canadians' confidence. So they're more likely to spend just in general when housing prices are up. Of course, the opposite happens when interest rates go up. Spending is more likely to be constrained on things like renovations and goods, and people generally tighten their belts a bit when housing prices are going down. Right now, and for the last year, we know that housing activity and housing prices have been unsustainably high. Basically, a spike in demand, low interest rates combined with chronically low supply, and we've had very elevated housing prices. This is part of what's feeding into excess demand in the Canadian economy, and as the Governor said, our goal is to get that demand down, and part of restoring the balance of supply and demand in the Canadian economy is restoring that balance in the housing market, and that's what we're aiming to do. We do expect, as the Governor said, that changes in housing activity and prices will feed through to overall economic activity.
Thank you. Before proceeding, I'm just going to ask once again people on the line to please make sure your phone lines are muted. We're operating with a slightly different technical setup today, and so it's important that everybody mutes themselves on the line. Otherwise, it's very difficult to hear what's being asked. Our next question is David George Kosh of BNN. David, please go ahead.
Hi there, Governor. Hope you're feeling better, and I'm looking forward to seeing you in person again. My question to you is, why did the Bank of Canada get its inflation projections wrong, and why should Canadians trust your inflation forecasts going forward?
Well, first of all, thank you. I also look forward to seeing you in person, and yes, I am feeling much better. Thank you. So in our monetary policy report, we actually go into this in some detail. It is important that we are accountable and that we explain our inflation forecast errors. And it's also important that we understand our inflation forecast errors as we adjust and seek to bring inflation back to its 2% target. What you'll see in the appendix is, so we've done our very best to try to disentangle the various factors that led to the inflation miss. And what comes out is about 2/3 of the inflation miss relates to global factors. The biggest one of those would be substantially higher oil prices. A year ago, oil prices were about $50. At the time, we thought that's not far from where they were pre-pandemic. At the time, we thought they would, our forecast was that they would stay roughly there. Of course, they've more than doubled that. The other important global factors, other energy prices, other commodity prices have gone up. And the other important global factor is we've seen severe impairment of global supply chains, which has further contributed to the rise in global goods prices. About a quarter of the forecast errors relate to the fact that the economy recovered faster than we expected and has moved into excess demand. The part of that that is showing up the most in the CPI is the unsustainable strength we've seen in housing, which has contributed to higher housing and rental prices. So when you look back at the errors, roughly 2/3 from international sources, a quarter from domestic excess demand. The actions we've taken today to front load the policy interest rate are really designed to cool demand, bring demand back in line with supply, take the steam out of those inflationary pressures. The other key element is by being proactive, by front loading, we're really trying to keep inflation expectations well anchored on the target. By keeping inflations well anchored on the target, as those global inflationary pressures begin to ease, inflation will come back down. If inflation expectations become unmoored and move up, then inflation is not going to come down when those international price pressures ease. We'd have to take even bigger interest rate. We'd have to move interest rates that much higher to get inflation back to target. By front loading, what we're really trying to do is avoid even higher interest rates further down the road.
Thank you. We'll go to the next question, Raul, from the Epoch Times, please.
Yes, thank you for taking my question, Governor. The bank's base case is the soft landing, despite the 100 basis points rate hike today and more to come. And there's some economic analysis out there that says that this would be an exception based on past several instances of recessions and rate hike cycles. You mentioned front loading the tightening cycle, and that tends to be followed by softer landings. But I guess I'm wondering, when you say front loading, wouldn't that have meant that you would have, raised rates like in late 2021 or January this year? So I guess the bank has already raised rates by 2% in the last 3 meetings. So I'm just wondering how this 100 basis points is front loading.
Well, since March, we've raised our interest rate 225 basis points. That is a very rapid increase in our policy rate. The other thing to keep in mind is that it's really only in the last number of months that we have built up the excess demand in the economy. As I stressed in my opening statement, it's this broadening, it's this buildup of excess demand in the economy. It's the shortages we see, the shortages for labor, the shortages for many goods and services. That's an important reason why these international inflationary pressures have broadened in the economy. And by front loading our interest rate response, that will cool demand, allow supply time to catch up and take the steam out of those domestic inflationary pressures. And as I just stressed in the previous question, it's critical that we keep inflation expectations well anchored so that when those international pressures ease off, inflation does come back down to target.
We'll go to our next questioner, and it is Heather Schofield from the Toronto Star.
Morning, Governor. You usually take a lot of care to give people a heads up and make sure you don't surprise anyone, but clearly that was not your mission today. And I'm wondering, what is the value of shocking everyone?
Well, in terms of the surprise, look, we had indicated that we wanted to get our interest rate up quickly to neutral. We had indicated that we were prepared to be more forceful. Today was more forceful. And as I indicated in my opening remarks, yes, it is a very unusual move to increase by 100 basis points at one decision. And that really reflects the very unusual exceptional circumstances that the economy we find ourselves in. inflation has not been this high in almost 40 years. Heather, I think the way you want to read this decision is this decision does reflect concern. It reflects concern that inflation is too high and it's affecting all Canadians. And it reflects concern that the risk that high inflation could become entrenched has gone up. There were really three important reasons for this unusually large step today. First of all, inflation is increasing, it's broadening, and it's persisting. Second, the economy is overheated. What started as global inflation from higher energy, higher global goods prices, is broadening here in Canada. And it's broadening because the economy is in excess demand. We're seeing shortages of workers. We're seeing shortages of many goods and services. We need to cool demand, allow supply time to catch up and take the steam out of inflation. And the third reason, as I've already stressed, is the desire to front load our interest rate response. By front loading the increase in interest rates, we're trying to avoid the need for even higher interest rates further down the road. As I've stressed a couple of times, front loaded tightening cycles tend to be associated with softer landings. And our objective is to get inflation back to target with a soft landing. Those were the key considerations that led us to this decision today.
Our next question comes from Eric Hertzberg of Bloomberg News, please.
Morning, Governor. Just to follow up on that question or that response directly, just with this 100 basis point hike, can you explain a little more in detail whether or not this means that you'll need to raise rates to a lower terminal rate, or does this help you get your job done a little bit better earlier?
Well, we took a big step today. We've put our policy rate in the middle of the long-run neutral range that we estimate to be between 2% and 3%. We did indicate in our press release that we expect interest rates will need to rise further to cool demand and bring inflation back to target. And by front-loading our interest rate response, we are trying to avoid the need to increase interest rates even further down the road. What this argues for is getting our policy rate up to the top end or slightly above the neutral range quickly. How high interest rates will need to go to get inflation back to target is going to depend on the evolution of the economy and importantly, the dynamics and evolution of inflation. I'd remind you that we have an inflation target, not an interest rate target. Getting inflation back to target is paramount, and we're going to take those decisions one at a time at our fixed announcement dates moving forward, based on our assessment of the economy at the time, and importantly, on the outlook for inflation.
We'll go now to Mark Rendell of the Globe and Mail, please.
Thanks for taking my question. Wondering if we can, zoom out a little bit. A couple of your counterparts at other central banks have suggested, the era of low inflation is perhaps a thing of the past. We're facing new structural forces in the economy, more supply shocks that makes getting back to target more difficult. I'm wondering if you share those views and if you have any comments on that.
Well, Mark, as as some of the other central bank governors, chairmen have talked about, as well as others. There are some global forces that have created a fairly benign environment for inflation over the last 15 years or so, that could be dissipating or even moving into reverse. When you look around the world, it's clear that the age of globalization has certainly stalled and possibly is moving into reverse. That could, that globalization put a lot of downward pressure on global goods prices. If that goes away, we won't get as much downward pressure from global goods prices going forward. There are other factors. Clearly, we have to deal with climate change. That could add costs. We have an aging labor force. Labor markets could become tighter. These things are relatively slow moving, and we will see. But the one thing I would stress right now is we have some ability to influence what that future looks like. And the best thing we could do today to make that future better would be to keep inflation expectations well anchored on the target. Because we know that if inflation expectations become unmoored, the economy is not going to work as well, and it's going to be harder to get inflation back down to target. And that's really reflected in the step we took today, increasing interest rates by 100 basis points and front-loading our response. An important reason for that is to assure Canadians that we are going to bring inflation back to target and they can be confident in price stability.
We'll go to Greg Quinn for Market News now.
Good morning. You may have seen rumblings from Royal Bank of Canada and even CMHC about a potential recession in the next year, and I note the scenario that's laid out in the Monetary Policy Report. When we think of a recession, we think of it as a broad-based concept, but unemployment is at a record low right now. There are employers complaining that the biggest problem is, they can't staff full shifts. I just wonder what your thinking is around the idea of if there is an economic slowdown, is recession the right label for a situation where output might shrink, but unemployment could still be close to the lowest it's ever been?
Well, let me stress two things. First of all, we do have a material slowdown in growth in our forecast. We've got 3.5%. We're forecasting 3.5% growth this year, coming down to 1 3/4 next year. That is a material slowdown. That is going to have an impact. But that slowdown is needed. We need to cool demand to give supply the time to catch up. And as I indicated, there's lots of room to reduce job vacancies without materially reducing employment. So, with respect to what this is going to look like, I think it's going to look like, the economy is going to slow. The economy needs to slow. We need to take the steam out of inflation. There are, as we indicated at the back part of our Monetary Policy Report, there are risks around that scenario. The biggest risk in our view is that Canadians could start to believe that the high inflation we have today is here to stay. And if that happens, if expectations of high inflation become entrenched, we will have to raise rates more and slow the economy more to get inflation back to target. By front loading, we're trying to avoid that scenario. There are other risks. There could be a sharper global slowing than we've built into our projection. That would have some impact on Canada. The other thing, though, is, when we look, as you highlighted, when we look at the economy, the unemployment rate is at a record low. Businesses can't get all the workers they want. Households still have $200 to $300 billion of extra savings built up from money that they didn't spend over the last couple of years because they couldn't buy many of the things, the high contact services they wanted to enjoy. There continues to be the potential for strong consumer spending going forward. We think our forecast balances the risks around the upside risks and the downside risks. But there certainly are risks that we take through, and we'll take our decisions each one at a time based on our best assessment at that time.
Thank you. Our next questioner is Julie Gordon of Reuters, please. Go ahead, Julie.
Hi, Governor. Thanks for taking our calls. Some feedback. I'm going to go back to Heather's question. You've been very clearly signaling what you plan to do before you do it throughout the pandemic and in recent months. But of course, this 100 BP hike was clearly a surprise for markets. It was a surprise for economists. Nobody was expecting it. Should we expect a shift from you now in terms of how you communicate what you're going to do? Are you sort of removing that almost casual forward guidance from how you interact?
Look, I think you can count on us to continue to explain, to communicate how we see the economy, how we're seeing it developing. As you suggested, the consensus was that we would do 75 basis points. We did 100. The consensus was, we were going to take a much larger than normal step. We did. We signaled we were prepared to be more forceful. We have been. But, deliberations matter, decisions matter. We're going to take our decisions one at a time based on the best available information and our best judgments at that time. As I said, you can count on us to continue to explain how we're interpreting ongoing developments. And you can expect us to take the decisions that we think are necessary to achieve our mandate and bring inflation back to target.
Okay, we have one more question here in the room before we go to the phones. The last question here in the room is David Reevely of The Logic. Go ahead, David, please.
Thanks very much. Governor, my question is again about the appendix and the forecasting errors. It's sort of an accounting of here's what the bank predicted and then here's what actually happened. Can you speak about what you and your team have learned from these errors that you're applying and looking forward to the economy now?
Well, maybe I'll let Senior Deputy Governor Carolyn Rogers lead off on that, and maybe I'll add something at the end. Go ahead, Carolyn.
Yeah, thanks for the question. Look, we've been really clear all along with Canadians that we're in an environment where forecasting is really difficult. We went through a pandemic, and then we're in a war. Either of those two shocks to the economy would have complicated forecasting. The combination of the two has more than and doubled that difficulty. So we've also been clear all along that we haven't got everything right, and we committed to providing Canadians with an accounting of where we think we went wrong in our forecast, and we've done that in the appendix of our NPR this month. As the governor said earlier, it's very difficult to isolate any one forecasting miss. There's a lot of things going on in inflation right now, and disentangling them and isolating them is difficult. But we've laid out where we think we went wrong. The most important thing to take from this is we are learning, we are adapting to what we're seeing. What we take from the forecasting errors is that while it is still global factors that are largely affecting inflation here in Canada, they are feeding through increasingly into domestic inflationary pressures. When global things like energy and food are increasing, those prices feed through to things in the Canadian economy that people buy every day. So for example, when food prices are going up, restaurant meals are going up. So what is a good service what is a good increase turns into a service increase. What we've said in our NPR this month is that we see that dynamic becoming more prominent. So those global effects feeding through to domestic pressures, it's becoming a more prominent part of the inflation story. And so that is a big part of why you took the decision we did today. We want to get ahead of that. We want to get that excess demand out of the economy so that those domestic pressures don't continue to build. And as global pressures come off, we can get inflation back down in Canada. So again, that's why we've front-loaded the interest rate decision today to try and restore that balance.
Yeah, I don't think I need to add anything.
Bon, alors passons maintenant au téléphone et nous avons quelques questions. Commençons maintenant avec M. Raymond Filion du réseau TVA.
Merci. Bon.
Oh, j'entends pas.
Monsieur Filion? Monsieur Filion?
Merci, j'avais pourtant fait étoile 6. Bonjour. Alors, je vais vous entendre, Monsieur le gouverneur, brièvement, parce que vous en avez parlé en anglais tout à l'heure. Qu'est-ce qui vous fait croire que ces hausses quand même importantes de taux d'intérêt qui vont affecter directement les ménages ne vont pas entraîner de récession, qu'on aura un atterrissage en douceur, comme vous dites?
Oui, merci. Comme j'ai mentionné, on pense que on peut ralentir l'économie sans avoir une récession. Dans notre prévision, l'économie, la croissance cette année, c'est prévisé d'être 3,5 et notre prévision que croissance va diminuer à 1 et 3/4 l'année prochaine. Donc ça, c'est une diminution assez importante du croissance et c'est une grande révision dans notre prévision vis-à-vis où nous étions en avril. Donc, oui, on pense que la croissance va modérer. En même temps, nous sommes maintenant avec un taux de chômage très bas, 4,9. C'est un record, le plus bas dans l'histoire. Et quand on parle des entreprises, qu'est-ce qu'ils nous disent? C'est qu'ils ne peuvent pas trouver tous les travailleurs qu'ils cherchent. Il y a beaucoup des postes qui ne sont pas remplis. Donc, il y a beaucoup d'espace de réduire les postes vacants sans augmenter de manière significative le taux de chômage. De plus, en contraste de beaucoup des autres pays, pour Canada, les prix des produits de base plus élevés, ça affecte l'inflation, ça affecte tous les consommateurs, mais ça rend plus de revenus dans le pays. Donc, nous sommes moins affectés par ces forces internationales que plusieurs d'autres pays. Donc, on pense qu'il y a une route pour avoir une soft landing. Mais quand on a souligné cette route est plus mince maintenant, et c'est pourquoi nous avons nous avons augmenté de manière significative nos taux d'intérêt pour essayer d'éviter le besoin des taux d'intérêt encore plus élevés dans le futur.
Thank you. We'll go now to Craig Lord of Global News, please. Go ahead.
Hi there. Sorry. Yeah, my question is just basically what should the message be for Canadians who may have been hearing rumblings about 75% and now are trying to interpret a 100 basis point move? Are you? Some people might think that it's a bit of a panic move, that the Bank of Canada is desperately trying to catch up to inflation. What's your message to Canadians who are surprised and confused and maybe a little bit worried about this?
Our message to Canadians is that high inflation is not here to stay. We are raising rates quickly, and we're doing that to moderate spending and allow supply time to catch up, to take the steam out of inflation. It is going to take some time to get inflation all the way back down to our 2% target. It takes time for higher interest rates to work their way through the economy and bring inflation down, but monetary policy does work. The other thing I would stress is, this is not going to be without some pain. We understand that higher interest rates are adding higher borrowing costs to Canadians at a time when they're already facing higher costs for groceries, higher costs for gasoline, and higher costs for many everyday items. But we need higher borrowing costs to reduce spending to to cool these inflationary pressures. The situation we're in right now is not normal. We need to get back to a more normal situation where inflation is going up roughly 2% a year. That's in that situation, Canadians will get back predictability. They can plan their spending. They can plan their savings. They can budget. They can live their lives without having to worry what prices are going to be next week, next month, next year. Our job is to get inflation back to 2% target. I want to reassure Canadians that they can be confident inflation will come down. That's our job, and we're going to do it.
Merci. Passons maintenant à Marie Chabot-Johnson du Radio-Canada.
Bonjour. Merci pour notre question. Vous reconnaissez que la Banque du Canada a mal évalué la hausse inflationniste actuelle. Mais à quel point est-ce que la hausse agressive d'aujourd'hui du taux directeur est pour les derniers mois d'inaction?
J'ai pas très bien entendu la dernière partie de la question. Peut-être tu peux juste répéter la dernière partie?
Oui, désolé. À quel point est-ce que la hausse agressive d'aujourd'hui est due à un rattrapage qu'on a besoin pour les derniers mois d'inaction qu'on n'a pas agi sur le taux directeur? Et surtout, à quel point est-ce que ça met pas les Canadiens entre deux contre-coups, entre l'inflation d'un côté puis la pression que ça leur donne aussi au niveau du taux d'intérêt qui leur rend leur vie plus difficile?
J'ai pas tout bien entendu, mais je pense que j'ai le sens du question. Donc, qu'est-ce que je vais souligner, c'est que oui, on était surpris de la force de la reprise. On est surpris du fait que nous avons tellement de demandes excédentaires dans l'économie. Ce n'est pas le plus grand facteur de l'inflation que nous avons maintenant, comme nous avons élaboré dans notre rapport sur la politique monétaire. Le facteur le plus important sont des forces internationales, la forte hausse de prix de pétrole, les problèmes dans les chaînes d'approvisionnement globales. Cela reflète à peu près 2 tiers de la surprise en l'inflation, mais à peu près 25% reflète le fait que la prise était plus forte que nous avons prévu. Et une raison importante pourquoi on est en train d'augmenter les taux d'intérêt de manière assez vite, vraiment pour 2 raisons. C'est pour réduire la demande, réduire la croissance des dépenses, puisqu'on peut réduire les pressions inflationnistes domestiques, et deuxièmement, de s'assurer que les anticipations d'inflation sont encore bien ancrées à notre cible de 2%. Parce que si les anticipations d'inflation, si cette haute inflation que nous avons maintenant, si les Canadiens pensent que ça va rester haut, on devrait augmenter les taux d'intérêt encore plus pour réduire l'inflation à notre cible. Et donc, l'action que nous avons pris aujourd'hui, le grand étape que nous avons pris reflète ces 2 considérations. Réduire la demande et maintenir les taux d'anticipation d'inflation bien ancrés.
Hey, merci. And finally, let's go to Pete Evans from CBC. Pete, over to you.
Hey, thanks. I had a question about one section in the NPR about the wage price spiral. I know you guys, it isn't the sort of base case scenario would probably be more fairly described as the worst case scenario. But is there a sort of metric you're looking for in the numbers to know when we might be seeing it? I think the last StatScan numbers showed wages were up about 5% in the year up to June, and that was up from 4 the previous month and 3 the other, which is a sort of pattern we've seen. So is there any sort of thing that you're looking to see to know that we are getting into a wage price spiral, and what do you think the odds are on that happening? Thanks.
Well, I'm not going to handicap the odds. I think what I would stress is by taking forceful action, we're doing everything we can to make sure that that risk does not crystallize. With respect to are we seeing a wage price spiral, I'd say so far we are not seeing a wage price spiral. If you look at wages over the last couple of years, they are broadly in line with productivity. We are seeing is that with higher energy prices, higher input costs, we are seeing firms passing through those higher input costs quite quickly into final goods prices. So that is showing up in our CPI. So oil prices go up, energy prices go up, everything that has to get shipped. The cost of shipping goes up. That's getting passed on into final goods prices. Food prices go up. Restaurants raise their prices. That's getting passed on in terms of more expensive restaurant meals. The reason we're seeing this much pass through is the economy is in excess demand. And so businesses can pass it through. If they can provide the service, if they can deliver the goods, when consumers are spending robustly, they're willing to pay, and it shows up in higher prices. That's why we need to reduce demand, bring it in line with supply, let supply catch up, so that we can take the steam out. As I said at the beginning, if Canadians start to believe that this higher inflation is here to stay, it could get built into a wage price spiral. And the lesson from history is that if that happens, it's going to take a much sharper slowing of the economy to get inflation back to our target. By raising rates proactively, by front-loading our response, we are really doing everything we can to avoid that risk materializing.
Thanks very much. We've gone over time. I appreciate everybody's patience. I appreciate everybody's patience with the technical setup and how we had to adjust today. Thank you all for the flexibility. This does conclude today's press conference. Thank you very much, Governor Macklem, Senior Deputy Governor Rogers. Thank you all for attending. And